We're here to talk about the Silicon Valley real estate market weekly update for August the 23rd, week ending August the 22nd. These are the key chapters that we're going to be going over. The order has changed slightly. I moved the distributions to the end of the Silicon Valley presentation section. I just thought that, that was a little bit of detail. Anyway, let's get into the data. What we have here is the gray line is the 10-year typical. That basically I compare the same week for the previous 10 years, 2015 through 2024. And what is 2025 data compared to that median. And you can see we're basically dead on. We're 2.2% more inventory than we typically do for this particular week. The red is the least amount of inventory you'd expect, which is defined by the 10th percentile during that 10-year period of time. And the blue line is the 90th percentile the most. The blue is always going to be what favors the buyer, an ice cold buyer's market. The red is going to be a red hot seller's marketplace. So here you have a neutral, basically right at 100% of the inventory you'd expect. The exact numbers over here on the right, 2798. You can see that just 13 weeks ago, we were at 3,174, and we had 28% more inventory than you normally do. Inventory in most regions peaked out on around July 19th, and we're down in all regions except I think it's Marin, Solano, and Monterey County are still above the July 19th number. So those three counties have increased. Every other county out of the 13 counties I follow. So 10 out of 13 are less inventory. Middle of July is typically when inventory peaks. Moving down to offers accepted. This is ratified offers in the past 5 weeks, as long as the transaction is still viable. In other words, it could be closed or it could be still pending. A lot of people report pending transactions. The problem with that is if you have a 1-week closed of escrow, that one transaction only counts for 1 week. And then if you have another transaction that hangs around for 7 weeks, it counts your statistics for 7 weeks. By looking at offers as they're accepted, each transaction counts for 5 weeks. They all have the same weight. The concept's the same, but now you can see the purple, the current data line is right on the blue line. So you have the least amount of offers accepted that you would expect. And we're basically at 79.9%, call it 80% of our offers accepted that you typically do. And you can see the typical number here is at 2840. We're at 2030. And you can see that it really isn't much change from 13 weeks ago. So I go back to the quarter, I go forward for a quarter, and in the middle, right where the data blue line cuts off, because we don't have current data for future, is this current week. So this is 1 week ago, 2 weeks ago, 3 weeks ago, and that's why the minus signs. And then this is 1 week into the future, 2 weeks into the future. Number of closings, or the number of transactions that actually consummated that were closed, only 72%. So you can see the number of closings is below the number of offers accepted. That would tend to suggest a larger number of transactions are falling through. The number of transactions that fall through tends to increase as the market becomes more balanced. The buyers are not just grateful to get a house as in a competitive marketplace, and therefore they're not willing to put up with as much problems on a property that may be discovered, and they're more likely to have a transaction fail. Days unsold inventory is the supply-demand balance. You can see that we're way above the blue line back here 13 weeks ago at 160%. We've actually improved fairly significantly. We're now only 17% slower. So we're now at 117% of the typical time to sell all your existing inventory. But what's that really mean? It means it's taking 48 days to sell all your existing inventory at the existing rate of sales. You can see the typical is 41, so we're a whole week longer. We're taking 7 weeks instead of 6 weeks. Is that significant? Yeah, it's significant, but it's not earth-shattering. It really, a seller that wants to sell can still sell their property in a reasonable period of time. Moving on to marketing time, days on market. This is the time that it takes 3 out of 4 sellers that are successful in accepting an offer to sell their property. It does not include the sellers that don't sell because there's no limit. I could look at days on market on the properties that are on the marketplace, but that's pretty misleading also. But so this would tend to be a conservative number because there are a few sellers that are legitimately trying to sell their property, and for whatever reason, the buyers are rejecting it. Now, clearly, the seller could correct that by adjusting their price. Who's being unreasonable? The seller that doesn't adjust the price, or the buyer that doesn't pay the price the seller is asking? There's two sides to every coin. But in any case, it's a relative benchmark that tells you how long a seller that's realistic out there, because 75th percentile is not out there like at the 90th percentile or the 95th percentile where you start getting weird stuff happening. It's the third quadrant. It's a common statistical number. Anyway, you can see it's now taking 7 weeks. Typically, it only takes a little bit more than 3 weeks. So to go from 3 weeks to 5 weeks is a lot more significant, but still to sell your property in 5 weeks is a very reasonable time frame. So the market is slower than it typically is, but it's still a very reasonably paced marketplace. Ask price cuts. This is what the seller reduces their own ask price in order to get the offer in the door. You can see that a quarter ago we were taking, 1% doesn't sound like a lot, but that's because most sellers do their homework ahead of time. That was double what it normally is. So normally it's only a half of 1%. It was all the way up to percent. Come fast forward over here and you're at 1 2/3%. Again, it's roughly double. So that means that normally it's about a 2/3%. Well, it's actually 90%, it looks like. So it's typically at 90%, and now you're at 1.7%. So you're not quite double the number of price reductions. And a soft marketplace is exactly equal to the 10 percentile. That's where these numbers come from. This is the blue line. This is the red line. That's the typical. The purple are the current number and then a ratio. Overbidding. A quarter ago, we were bidding 6.2% over the seller's ask price. Normally at that week, we're at 7.8%. So we were 1.6% below the normal amount of overbidding. Now we're only at 2.8%, which, for most areas in the country and for most big ticket items, to get over what you're asking for by almost 3% is pretty significant. But typically we're getting overbid by 6%. So you're 3.1% less overbid than you typically have. And in a competitive marketplace, it's all the way up to 7. In a slow passive marketplace, it's 3.2. And since we're below the blue line, you have even a lower number of 2.8% overbid right at the moment. Now we're looking at long-term performance of 3 key indicators. The gray lines here that are evenly spaced are on a condensed scale to the left of the green line to before January 1st of 2024. The full year of 2024 is on what I call the expanded scale, and the year to date in 2025 is on the expanded scale. And that's so that you can see the trend, like slopes and things like that, in 2024 to compare to what's happening in 2025. Purple line is active inventory. You can see we're just above the 100%. I think the number was 102%, and that looks real reasonable. Moving down to offers accepted, you can see that we're only at 80%. You can see that we've been basically at 80% since, I would call it, late fourth quarter of 2022. So we're approaching 3 years of lack of inventory. That more than compensates for the surplus surge that we had right after COVID here, where we were selling 30% or 20% more offers than we typically do. We've now been giving up 20% for twice as long. So we've now had a deficit of transactions. I will also make an off-the-cuff comment that for whatever reason, and I think it's stability due to capital gains and property tax, the number of transactions in Silicon Valley has been basically going downhill long-term ever since I got in this industry back in the early 80s. You would expect the number of transactions to increase as the number of population and the number of homes available to sell increases. But the reverse is true. Sellers getting more and more anchored in their properties. And then the key indicator is the gray line, the days unsold inventory. You can see that you're about 118%, 18% slower than you typically are. So that's taking longer to sell. Now you can see that we had a huge slowdown earlier this year, and I actually expanded my scale for this when we were breaking through 70%. I didn't know how far up it was going to go. It didn't go very far above. The only time we were at this level was during COVID shelter in place. You can see that was a record high for a normal marketplace. But we've improved fairly dramatically, and we're still appearing to continue to improve. The biggest thing is we're missing 20% of the marketplace, 20% of the transactions. Here now is the active inventory. You can see that at the beginning part of this year, beginning of 2025, we had a shortage of inventory. You were right here on the red line for several weeks. But once we hit New Year's, we grew at a greater rate and got back up to the normal level of inventory. And then we continued to grow in the second half of first quarter, and we got all the way up to the blue line. And then in the first half of the second quarter, we actually went above the blue line. And then we were sort of hovering right around the blue line. And then we did this fairly dramatic drop in inventory, which, when you look at it, you have other periods of time when you've had significant drops. But this is a drop that's more significant than normal, because if it was a normal drop, you wouldn't be pulling away from the blue line, or you wouldn't be pulling away from the gray line. Right now, we're not pulling away from the gray line. In fact, it looks like we may be turning around and getting a little bit more inventory. Here's active inventory on a percentage basis. You can see that when you had the surplus inventory, that's right back here where we were at the end of 2018 and the beginning of 2019. And this is for all of Silicon Valley, by the way. This is Alameda County, Santa Clara County, and San Mateo counties all in a blender. You can see the significant improvement. So you sort of had a glut of inventory right at the end of first quarter, beginning of second quarter, first half of second quarter. But now that we're in third quarter, we're back at absolutely normal levels of inventory. Here's offers accepted, same concept. You can see that we've had a shortage of inventory. In 2023, we're slightly below the blue line. 2024, on both sides of the blue line, and in 2025, both sides of the blue line. And right now, we're right on the blue line. We did go slightly above the blue line for most of second quarter, but I would say we're right back on it now. We were on it for most of first quarter. So here is on a percentage basis, you can see the slight improvements and the slight regressions. We're basically floating right around 80%. Long term, maybe that's only about 77%, 76%, something like that. And then it's an improvement from where we were in 2023, where we only sold 70% or we were missing 30% of the marketplace. So the lack of the market, the lack of transactions is clearly the story that needs to be told, in my opinion. It's improved slightly from 2023, but still, if you're missing 20% of the market based on the past 10 years, that's pretty significant. Now, maybe you can argue that the years going into COVID were robust. COVID was robust, so these numbers are overinflated and you would expect it to be lower. That's a reasonable argument, but it remains that we're selling less homes, less transactions right now in the last couple of years than we've had based on the past 10 years. Now, this will continue to change. In another 4 months, I drop off 2015 and add in 2024, and that shifts the whole number. I do it. That's why I'm doing things compared to the 10-year median, is because the marketplace does change over a long period of time, and I thought 10 years was a reasonable benchmark. Here's the days of unsold inventory. You can see that you've been floating above the blue line, so slower, longer turnover time. This is how long it takes to turn over your entire inventory at the existing rate of sales. And you can see that, it's still a reasonable number. I think it's about 48 days, but you're at 50, you're quite a bit above the blue line, and you're significantly above the gray line. The gray line, again, is where you'd expect the market to be based on the past 10 years. Here's on a percentage basis. You can see we were up in record territory. Only shelter-in-place COVID timeframe mirrored us. If you come back and look at this, sort of the high is 150%. So we're nowhere near that now, but we were at 172% or something like that. So we were quite a bit above. Here's the marketing time. You can see the thing that I find interesting on this chart, and you can check me out because I have all the data here for you to view. The peaks all align. See how all those peaks align? But now notice the purple peak. It shifted to the left. It shifted earlier. Normally, the peak happens middle of first quarter. It happened right at the end of fourth quarter, beginning of first quarter. The valley happens right in the middle of first quarter instead of the middle of second quarter. So now you're a whole quarter early, and now your rapid run up happened. And it almost looks like the dip that happens midway through fourth quarter is happening midway through third quarter. You can really see there's really no dip in either the slow marketplace or the typical marketplace. You get down to the hot marketplace and there's a dip. But, we're nowhere near that marketplace. So comparing the red line to the purple line really doesn't make sense. So there seems to be a horizontal time shift where the marketing time and stuff is reflective of later in the year for whatever reason. And that may be why we're climbing so much. But I have no idea, and no one has reached out to me with a hypothesis on why this graph has shifted. It's been there for the past 10 years plus, so this is the first year. It's the only year out of 11 years that you have that horizontal time shift. Here's the marketing time. You can see that it was going up and it reached the peak right at the beginning of third quarter, July 4th timeframe. And then it improved and we turned around and we slowed down slightly. We're at 50% longer marketing time for the 3 out of 4 sellers. Here's the largest price reductions. You can see that we're taking larger price reductions than we do in even a cool marketplace. And this is the seller that's taking the largest price reduction. I define that as the 90th percentile. I use the 10 and 90 or in the 25 and 75 quite a bit in statistical. Statisticians use quadrants, which are 25, 50, 75. In real estate, if you told people that 50% of the homes were between these two prices, they'd go, well, I'll look for the 50% that aren't between those two prices. But if all of a sudden you use the 10 and 90 percentile and 80% of the homes are between these two numbers and only 10% are lower and only 10% are higher, they start realizing that the pricing point that they're looking for in that particular area isn't realistic, which is part of the reason I started looking in at 10 and 90 percentiles. With ask price, it's a little bit more specific. It's the fact that most of the sellers do their homework, and most sellers, even in a slow marketplace, do no price reductions whatsoever. We're running right now around 22% in Silicon Valley, I think, of the sellers are doing a price reduction. That means 4 out of 5 sellers do no price reductions. And if you brought all that data in, you're just averaging in a bunch of zeros and reducing the numbers. So This is the seller that's taking the 90th percentile price reduction, the largest 10 percentile, and it's approaching 16%. So that's pretty significant, especially when you're talking about prices in the millions of dollars like we are here in Silicon Valley. Here's on a percentage of normal. You can see that we're about 38% or so more price reductions than we typically are. And you can see that it's been up all the year. You can see it's been up ever since 2023. What's interesting on this particular graph, in my opinion, is this rapid run up in 2022. That was when the market was collapsing and people weren't paying attention. Notice it really started sometime during first quarter. I actually go back and pin it on Valentine's Day, and that makes sense. If the market really changed on Valentine's Day on 2022, and it took sellers a while to react, the price reductions are going to show up a little bit later. But anyway, clearly by April the 1st, price reductions were skyrocketing. And you went from basically no sellers taking a price reduction, which you can't get better than, to 60%, 70% more sellers doing price reductions than normal. Here's the average. I put this in just to show that you can't, I'm not playing drastically with the numbers. Yes, my 10 percentile was below the blue line. This is slightly above the blue line. Here, the sellers are only taking 1.7% price reduction, which is the number I threw out earlier. So, it's a more reasonable number, but that shows why diluting it with a bunch of zeros. If some sellers are taking 16% price reductions, but an average is 1/10 of that, that's pretty dramatic. Here's on a percentage of normal. You can see that basically right at the end of first quarter, beginning of second quarter is when we were doing the biggest price reductions this year. And now you're back up a little bit more reasonable, but still on the larger price reduction side of normal. Here's the frequency of those price reductions. So how common are they? Right now, you're at 22% of the sellers are doing price reduction. 25 is way up here. So it's between the gray line and the blue line. So more than typical, but not unreasonable. You can see the frequency of price reductions. That's how common are the price reductions, has actually fallen off a little bit or stabilized in a time of the year when it's normally increasing. So the number of sellers doing price reductions is staying relatively fixed, even though it's normally increasing. So here you can see the frequencies has been decreasing. It recently reversed and went back up. You can't tell whether these are just little bounces because you can see there's bounces all the time. This is updated every week based on the previous 5 weeks data. This is median overbid. So you can see right now for Silicon Valley, you're very close to 100%. You're basically getting your asking price. You can see it's very rare. There are little periods of time in Silicon Valley where you get less than ask price. We had this one big period in right at the end of 2022, at the beginning of 2023, where it was common to get below ask price. But we're getting very close to just getting 100% of the seller's asking price. And this is the median. So this is the halfway point. The number that was like 2%, that's the average. And that gets pulled up because some people pay 20% over, 10% over, and that pulls up a lot, especially in real estate. Buyers, for whatever reason, are reluctant for the most part to go in and offer the seller much below their asking price. So the percentage below 100% is pretty limited. Here's what we're talking about on overbidding. This is the average overbid. This is the magnitude. So typical would be right up here at 0%. So typical, if you were at typical, you would be exactly typical. So the difference between typical and your exactly normal is 0. So now you're taking basically 3% less overbid. You're receiving 3% less overbidding than you normally do. So if I remember correctly, we were receiving something like 2% overbidding and you're normally receiving 5% overbidding. That's the 3% delta. I don't do a percentage basis on this. This is just raw comparison difference. Here's the frequency. So basically still 51% of the sellers are getting more than their asking price. So again, that's slightly below the blue line, but still for half your sellers to get more than their ask, you can't complain about a marketplace where that's happening. Here's the frequency of overbidding compared to normal. So we're basically at 75%. So overbidding is less common, but you're missing only 25% of the overbids that we normally do. This is how frequent it is. And you can see how the rate this line's been coming down. If you wanted to try to project in the future, you tend to go down along that line. The other thing to keep in mind is the lines here look like they might be steeper, but the x-axis here, the horizontal axis, is twice as condensed. So if you brought this back and cut it in half, this steepness of this decrease in the frequency of overbidding would roughly equal the slope of the line here, in my opinion. This is obviously for a longer duration, a period of time, and a much greater vertical period, because this is covered basically a full year. Here, your peak here to here is only half as long. It's two quarters, because it was half of first quarter, all of second quarter, and half of third quarter. Here now is looking at a long-term pricing model on log paper. I think the more accurate representation is we had roughly 12% appreciation from 2014 through midway through 2022. And since midway through 2022 to present day, we had basically no appreciation in housing prices. Yes, it was depressed in 2023 slightly, but now we've come back and we're on the high side here early in second quarter on the high side. We're now dipping below. That's the seasonal cycle. It has to do with market mix and not really property values. So this would be my first broad brush cut on what the market's doing price wise. Now we're going to look into the three counties that make up Santa Clara County. You have Santa Clara County in the blue, Alameda County in the gray, San Mateo County in the orange. I will point out that San Mateo County reached a record high level. If you look back, they didn't have 600 listings anytime in the past 10 years. And we're still at record high numbers other than or just earlier this year, especially when you do compare to the year. Now, you got little times here right at the end of third quarter, which is only a couple weeks away, where you had slightly higher inventory. But the main takeaway here is San Mateo County clearly has its inventory back. Alameda County clearly has its inventory back. Santa Clara County has its post-pandemic level inventory back, but it's nowhere close to its pre-pandemic level of inventory. Look at how high these numbers are. They're up around 1,400. We're missing almost 40% of the inventory. Offers accepted. Santa Clara County is accepting the most offers, so it's going to have a much faster turnover rate than Alameda County in the gray that had more inventory and has actually fewer transactions. And then you can't compare San Mateo County right off the bat. You'd have to do a ratio, which is going to be the next slide. So here's that ratio. Santa Clara County has the fastest turnover rate or days unsold inventory at 42 days, followed by San Mateo County at 45 days. And then in third place, and still fairly quick, is Alameda County at about 56 days. That's only 8 weeks. To sell your entire inventory out in 8 weeks is a pretty good turnover rate for something that doesn't spoil like bread. Here now is the 75th percentile of the marketing time. Look how close together all three of these counties are. You have Santa Clara County at 33, San Mateo County at 35, and Alameda County at 37. Here's the magnitude of list price reductions. Alameda County is doing the most price reductions at almost 2%, and this is average. Santa Clara County is just over, well, it's at 1.6%, and San Mateo County is at 1.3% price reductions. It's fairly small. This is average. Multiply it by roughly 10 to get to what the biggest price reduction sellers are doing. So in Alameda County, rough numbers, it'd be almost 20%. I think what we're going to do when we dive into Alameda County is we'll see that the frequency of price reductions has increased over that typical 1 in 5, which is why they are at a 2% reduction. And here is the frequency. So it is slightly higher. It's not as high as I was thinking it might be, but in Alameda County, it's 24% of the sellers are doing price reductions. It's 22% in Santa Clara County, and San Mateo County is doing the least at about 17.5% of the sellers are doing a price reduction. That means that in all three counties, more than 75% of the sellers are doing no price reduction in order to get their property sold. Here's the overbid magnitude. So Santa Clara County is 2% overbid, and this is average. San Mateo County is about 3%, and Alameda County, that has the largest price reductions and the most frequent price reductions, has the most overbidding. You wouldn't expect that, but I think what's happening is sellers are adjusting their price. They're overshooting where the market is. They don't understand how sensitive the market is to pricing, and that causes the buyers to go, wow, even though this property's been on the market for 30 days, 60 days, 90 days, but it's now priced reasonable, we'll pay more than the seller's asking for, even though he's been on the market forever. Here's the frequency of overbidding. All three counties are fairly close together. Santa Clara County is trying to lose the race on this one. It's down under 50%. It's only 48% of the sellers are getting overbid in Santa Clara County. In San Mateo County is second at 52%, and Alameda County is third at about 53% of the sellers are getting more than their asking price. Here's the long-term appreciation. Santa Clara County had been doing the best by a significant amount. And I was pointing out during this period of time that it was market mix, and we'll get into that later in the presentation. You can see that San Mateo County and Alameda County are very close together at basically about 70% appreciation since the last 9 months of 2015. Here are the actual prices. This is on log paper. The following will be on regular paper. You can see Alameda County is the cheapest, most affordable area, and it's clearly below its 2022 pricing peak. In fact, it's below the pricing it had in 2021. Next on the order is the blue line, Santa Clara County. You can see it's below its 2022 pricing, but it's significantly above its 2021 pricing. And San Mateo County is below 2022 pricing, but right at 2021 pricing. And then, when you start looking at it this way, you can really start seeing how prices have been fairly flat. Yes, there are high times in the year and there are low times in the year, but pricing overall isn't going in the upward direction like it was back in these years with a steady climb. Here's that same information on regular paper, so you can see that San Mateo County has dropped to 1.9. Santa Clara County is back down to 1.8. Santa Clara County first reached that level back in early 2022. But San Mateo, as I was saying, reached their current level back in 2021, as did Alameda County. Here's the estimated payments using the national average for high balance conforming money, so that these are most likely an overstatement of your payments because jumbo money is cheaper here in California, and I am putting in a reasonable estimate for property taxes and insurance, so it's the total PITI payment. So Alameda County has the most affordable at just over $9,000. Santa Clara County is about $13,500, and San Mateo County is at about $14,500. Here now is the micro-market data, and I added in highlights so you can jump down and more easily find Silicon Valley, Santa Clara County, San Mateo County, and Alameda County. You can find each county. And for the first couple data points, I don't have Alameda County micro-market areas. I will probably be introducing that in the not distant future. I may do it next year based on a abbreviated, and these are all on 10 years. I don't have 10 years worth of Alameda data on the micro-market data, but I think I'm up to 7 years, and I might be comfortable going through with 7. I'll have to go back and dig into my data and find out. Anyway, I'm trying to highlight it so you can get the counties and then each micro-market area underneath it. And this is the percent of normal. So right off the bat, you can see that Campbell, Santa Clara, Cambrian, Willow Glen, as well as and Los Gatos, have less inventory than they typically do. And most of the areas are in Santa Clara County are right around their normal level. Los Altos has the most at 20%. But you come down to Alameda County, and they're getting up to 30% in Half Moon Bay. The only area that has a shortage is Atherton at 90%. And then Alameda County is all at 98% because I don't have micro market data. Here's the offers accepted compared to the 10-year median. You can see that we're having that shortage. San Mateo County right there at 100%. So they're back to the normal level offers. Santa Clara County is at 80% and Alameda County is only at 75%. So Alameda County is missing 25% of its marketplace. Here's days of unsold inventory. Again, you can see Silicon Valley is at 17% slower than normal. Santa Clara County is at 8% slower. San Mateo is at 17, almost 18%. And Alameda County is at 21%. If you look at micro market data, let's look and you go anywhere from 80%, so 20% faster than normal, to almost 100%, twice as long. I'll actually go down to Foster City, and it's more than twice as long. Now, Foster City is a very small micro market area, and so, the Half Moon Bay coastal areas is fairly small on the number of transactions. So that maybe that really isn't a fair comparison. Maybe I need to go down to something like Redwood City at 137%. But you can see that even one county, and the same true with Santa Clara County. Saratoga, Los Gatos, not a small micro market area, versus Morgan Hill, Gilroy at 156%. There's a lot of variation within the county. So to just talk about what Silicon Valley is doing up here in the first number, I think it's really a disservice, which is why I put in the 3 key counties and the micro market areas underneath there. Here's your days on unsold inventory. Again, you can jump to each county, 48 days overall. Santa Clara County is the fastest at 42 days, and the slowest is Alameda County at 57 days, 56 and a half. Here's your marketing time, 40% longer than normal for the 10-year. And I don't know if you picked up, but I go 10-year, what the data means. So now we're doing the 10-year comparison. So you're clearly slower, 61% slower in Alameda County, 31% slower in San Mateo County, and 35% slower in Santa Clara County. Here now is what those numbers are. So even though we're slower than we normally are, they're all basically about 5 weeks, 33 days, 35 days, 37 days. When you look at the 10-year comparison, it looks pretty slow. But you come in, you look at what does that really mean, and it's still fairly fast. For 3 out of 4 sellers to sell their home in 5 weeks is still reasonable. Same thing here. Now we're back to the 10-year comparison. You're down. Actually look at San Mateo County, right at 100%. But now Alameda County missing 6%, 6% price reductions on average, 6% more than typical. Santa Clara County is 2% more. I thought that would be significant numbers. I may have to expand this out to have some color because a lot of this is saturated red or saturated blue, which tends to indicate that I didn't do a wide enough range, and that's possible. But now what's it mean in magnitude? You go down to Alameda County where they were doing the biggest price reductions. In Oakland, it's 3%, in Castro Valley, 2%, 2% in Pleasanton. You come into Alameda County and you're about 1.3, and Santa Clara County is in between at 1.6. These numbers are reasonable, but that's because they're weighted by those 50% or almost 75% of the sellers that do no price reductions. This is the frequency compared to the 10-year median, so we're taking 20% more, but look at the distribution. Both Santa Clara County and San Mateo County are essentially normal frequency of price reductions. The extra price reductions are all happening in Alameda County. Now, again, I need to point out you're 50% more price reductions in Milpitas, and you're only 3/4 of the price reductions in Cupertino. So again, each county can't be painted by one brush, which is why I try to provide this micro market data so you can make a more informed decision. Obviously, what you want to do is when you're offering a house for sale or making an offer on a house that's listed for sale, either of those two, you want to get into the details of what's happening for similar price areas in similar geographical areas, similar homes, to understand with more than the micro market areas. But this allows you to see what's happening in the Bay Area, then by county, and then by 6 or 7 micro market areas within the counties that make up Silicon Valley. Here's the frequency, just raw numbers, maybe 25%, well, 22% in Santa Clara County, but it varies from a low of 7% in Cupertino all the way up to a third of 30.5% in Morgan Hill. The variation in San Mateo County is anywhere from 0 to 23%. In Alameda County, you go from a low of 6% in Berkeley to a high of 32.5%. So you can see there's a huge change in the frequency of price reductions, and that's an indication that the sellers and those listing agents are misreading the market in those counties or those micro market areas by significant amounts. Some areas are not misreading it at all with no price reductions. Here's overbidding. It's less. This is compared to typical. So you can see, 3% less isn't all that much in magnitude, but that's fairly significant compared to what I'm used to seeing. Here's the buyer's magnitude. So even though it's less than you expect, Santa Clara County is getting almost 2% overbidding. San Mateo County is at 3%, and Alameda County is at 3.75%. So again, it's sort of interesting with Alameda County getting the most overbidding when they're the slowest county. But again, I've already explained that it's most likely the sellers are doing the price reductions and causing the buyers to come in and overbid. Here's the frequency of overbidding compared to the 10-year median. So we clearly have less overbidding. It's somewhere around 3/4 of the normal overbidding. Santa Clara County at 72%, San Mateo and Alameda County exactly tied at 3/4. So you have only 75% of the overbidding you typically do on a frequency basis. But what does that actually mean? It means that half the sellers are getting more than their overbid. So when you look at the comparison to the 10-year median, back one slide, it looks pretty bleak. When you come over and look at the raw numbers and ground yourself in reality, it's still a lot of overbidding. Now, in areas like Pleasanton, we're only 1 in 4 sellers, and in the San Mateo County coast and in South County, we're only 1 in 4 sellers are getting overbid. That's actually a fairly cool marketplace. It's just a phenomena in Silicon Valley. Even when we're in a slow marketplace, about 15% of the sellers get overbid, which is why I saturate blue at 15% up here. Here's the appreciation. So this shows you not where the hot marketplaces are, but the areas that have done the best since 2015. You can see Santa Clara County micro market areas have done the best. San Mateo County across the board have done the worst, and Alameda County is very split. I will also point out that if you look at Santa Clara County, 88% overall, there's only one area, Milpitas, Berryessa, Blossom Valley, Santa Teresa, that has a greater number. So the appreciation for the county is not reflective of the appreciation overall. I'm going to move these because it's more clear now down in San Mateo County. The county overall has had 70% appreciation, but there isn't a single micro market area that even hits 60%. And so how do I possibly explain that? Simply the areas that are more expensive than the county median, such as San Carlos and Atherton, are making up a greater percentage of the marketplace now. So anytime they sell a property, they raise the median, even though that's not raising property values. So the county is less reflective of property values than the micro market data. And then CMA data that I don't do on here is more reflective than actual micro market areas. My experience is micro market data gets pretty close because I spent a fair amount of time grouping my micro market areas to a CMA with a lot less effort. Here's your sold price, and instead of following just the median number, which is the middle number, I sandwich it with the cheapest 10 percentile on the left and the most expensive 90 percentile on the right. So you can see for single family homes in Silicon Valley, the range is from 850,000 all the way up to 3.3 million. But now if you look at the areas, you can see you can come down into Alameda County and you can buy in Oakland for as little as 460,000. And if you go on the expensive side, I would raise, it's right here in Atherton, 9.3 million, almost 9.4 million. So the range is a much greater when you start looking at the micro market areas. But this allows you to pick, if you have a particular budget, you can come down, sort of find the budget range in the middle number, and then start getting estimates of what areas can you find property in. For example, if you have a budget of 1.5 million, you can find a property in Campbell. It's going to be a challenge, and that's sort of how you can use this information. Here's a summary. Here, instead of alternating, I grouped all the comparisons to the 10-year median in the green over here on the left-hand side, and you can see how blue that chart is. But then when you come back to just raw numbers here on the yellow highlighted sections, is a lot more balanced. And then the overbidding is a lagging indicator because we need that close of escrow, and it's more favorable to the seller, so it's more pink than it is blue. But we're clearly becoming a more balanced marketplace than Silicon Valley typically is. And an interesting observation is Silicon Valley spends very little time in a balanced marketplace. It's either in a seller's marketplace or a buyer's marketplace. It transitions through buyer's marketplaces and going between the seller's marketplace and the buyer's marketplace, but it tends to not be stable or spend any time there. Here's the number of transactions. You can see that we've had a lot of second worst years, 9 out of 10, which isn't necessarily that significant. But when you come out here and start saying it's 24 out of 25, that's pretty significant. And just last week, I said I didn't think this record would fall here, but now there's only one property difference. So I would actually say that it is probably going to flip over. It flipped over from the week before, but in 2022, we had less transactions. So the big takeaway is your lack of transactions when you're basically 23 or 24 out of the last 25 years for a significant number of weeks, you clearly are missing a good part of the marketplace. The volume is just not there. Here's the raw numbers for Silicon Valley, as well as Santa Clara, San Mateo, and Alameda County, where you can look at the metric that you like the most. New listings doesn't show up anywhere else. It just shows you, and it's basically balanced. Santa Clara County gained 1.4% new listings, where Alameda County lost 1.1. You can see the active number of new listings. There's some data that shows up here that isn't in my presentation. The days of unsold inventory is the median days. And here's all three different marketing times together. You have the median that a lot of people quote. You have the average, which is misleading. And you have my favorite, the 75th percentile. The reason the median, I think, is misleading is the way real estate is done is half the homes are being sold pretty close to as soon as the seller will accept offers. That really doesn't change even as the market changes. And we'll see that in the days on market distribution that's still to come with my new organization. Now we move on to three distributions. The first one is every transaction, actually only half the transactions, from 50% the median up to 90 percentile, so only 40% of the marketplace, but it shows the distribution of where the market is reflective of market conditions. 50% is the median, which is why I don't like using the median. See, there's almost no change from last year to this year. The numbers are right on top of one another, where if you come out here to 75%, you were probably at something around 25 last year, and you're probably at something like 38 this year. So there starts to be a significant difference in the time frame, and it's showing that the market slows down. Basically, the closer to the blue line you get, the slower the marketplace is. The closer to the red line, the hotter the marketplace is. The dotted line is where we were a year ago on August 23rd, 2024. The purple line is where we are today, August 23rd, 2025. Now, what we're going to do is start off a year ago and just jump 1 week at a time for 5 weeks, and then start jumping 2 weeks at a time. So this is the 1 week section. That's the last 1 week. Now you're 2 weeks at a time. So it really isn't moving around very much. Now you can start seeing the slowdown for the end of the year. There's the slowest the market got. Then it rapidly peaks up. Notice the steepness here on the right-hand side. So now the market's already slowing down again as that flattens out. And the last 5 weeks coming up, starting right now, are weeks at a time. So you can see that for the last 5 weeks, it really hasn't moved very much. And what are we expecting? We're not expecting this to change very much going forward. until we get later in the year and it starts slowing down for the end of the year. Same concept with price reductions. Dotted line up here is where we were a year ago. The purple line is where we are today. Clearly, you're taking either larger price reductions, which is the vertical distance. The vertical separation would be the size of the price reduction. The horizontal distance coming from the dotted line to the purple line is the magnitude. So last year, 2.5% of the sellers were taking 11% price reductions. Now it's at 5%. So the number of sellers taking that 11% price reduction has doubled. You can do the same thing up here. You're at 7.5%. You come across and you're not out to, you're somewhere around, call it about 11 3/4. So you're about 50% longer, frequent, more sellers are taking that same price reduction, which is at 6% off the 100%. But again, the concept's the same. The best we ever had was the red line up here, which was basically right there in 2022 when no sellers were doing any price adjustments. The worst we had was just 9 months later in December 27th of 2022 when the sellers were taking large price reductions. They were large because of the time of the year and also because the market slowed down. Sellers had priced their home before the slowdown and resulting in larger price reductions. So stepping through, you can see like on days on market, there really isn't much change at this time of the year. So you wouldn't expect much change from the purple line either because the real estate's very cyclical from year to year. Now you're starting to see a downdraft right there, right at Thanksgiving. It really bounced and it already is starting to race up. There's the peak of the marketplace on Valentine's Day as well as March 1st. And now it's already cooling off. So the bottom of the marketplace happens right around Christmas time. The peak happens right around Valentine's Day. Now we're getting the 1 week sample size. And you can see it's been actually bouncing around. But notice these lines are sort of the coolest lines. So even though you don't expect much change, the purple line, you can see there really isn't any line that's wholly below that. For example, you get over here and the lines are all above. You get up here and the lines are all above. It's just doing a little bit of a different shift in the middle of the distribution, which is around 10 to 12% of the sellers, what they're doing. That's the largest. This right here is 2.5%. So this is the largest. I normally quote what's happening at the 90 percentile. So that's right at this point here. So it's representative of the marketplace. And notice by the time you get up to only 17.5%, a lot of the lines are already at zero. Some of your stronger lines are zero at 7.5%. And that wasn't even the strongest marketplace we were, which is obviously here. And they're even 2.5% of the sellers were taking no price reduction. Moving on to overbid. This shows the market competitiveness. What are buyers doing to ensure that they get the house? And you can see the purple line is the coolest line on there. You can see where we were a year ago. And the same concept, there really isn't much change in those dotted lines. Now, this isn't current market conditions because we need the sale price, which gives us a 4 to 6 week lag time. And you'll see that lag time where the prices really start changing right now, right at the New Year's. And then they continue to go down past New Year's, right January 31st. Then they heat up really rapidly. They stay at the top for a while, and then they cool off. And they're cooling off by middle of April. And you continue to cool and continue to cool. And then that's July the 5th. Now you're basically stable and just bouncing around. So again, this sort of gives you an indication of what the market's likely to do. The big takeaways are the overbidding is the least it's been, and we're still significantly above our worst week ever, which again was very close. Well, it was November 30th of 2001. That was right at Thanksgiving of 9/11 before the nesting image really took off. And the best week was here on March 29th and of 2022. And if you think about it, if you take 4 to 6 weeks back off of March 29th, 2022, you get to Valentine's of 2022, which is when those offers were negotiated. So basically right at Valentine's Day is when the market started to slow down. Now, granted, a lot of people didn't realize that until later in the year, but we did have a fairly significant correction, as almost everybody knows, in 2022. We've been talking about the Silicon Valley real estate market. We will be going on to talk about the Greater Bay Area, 13 counties. To see an archive of an old episode, you type in the blue YouTube URL up here, or the shorter green root URL. The green root URL is important because if you want to join the presentation Saturday morning, you type in the green root URL plus 2025. If you don't like, secondary links, the full link is in the description of every one of my episodes, and the passcode is here if you need it. The green root URL, the letter H for handout, 2025-08, and today's date, the 23rd. We give you the handout. I did get it up. It was about 7 minutes before the hour. I try to get it up about 15 minutes before. And if you want any specific episode without going to YouTube, you just type in tiny root URL, the year, month, and date that corresponds to Saturday. I'm Richard Calhoun, real estate broker with Creekside Realty, representing either buyers or sellers in single agency transactions here in the Silicon Valley. I appreciate likes and subscriptions. Let's move on to the Greater Bay Area. These are the 5 regions. We've been talking about Silicon Valley. We then have the cities, the North Bay, the Central Valley, and the Central Coast. Likewise, it's been single family homes for the past 5 weeks. And my 10-year reference is 2015 through 2024. Purple is Silicon Valley. You got the condensed scale on the left side of the green line. You can see Silicon Valley. This is active listings, 2750 active listings. The region that has the most active listings is the North Bay, and it's closest to its previous record, pre-pandemic record of inventory. For the Central Valley is the yellow. It's pretty close. Silicon Valley is fairly close because San Mateo is setting the record high. In Alameda Counties there, it's only Santa Clara that's lagging behind. And if you move down to the Central Coast, it's a little bit below, but fairly close, as so is the Marin. So from all practical points of view, the 5 regions have gained back their inventory and have fairly normal levels of inventory. Now we're looking at offers accepted. The offers accepted are clearly down. The numbers here for Silicon Valley, and Silicon Valley has the most, even though and it's typically right there at the most, but all 3 are very close together. You can see Silicon Valley's been doing better in 2024 and 2025. Silicon Valley is often the first to recover after a slowdown. And when was the slowdown? The slowdown was in 2022, and then we started having recovery. Basically, Silicon Valley is selling the most with not necessarily the most offers, so it's going to have the fastest turnover rate. Then you have the North Bay, which is outperforming the Central Valley. And then the Central Coast and the cities are very similar to each other and the same level as they were before the pandemic. They really don't seem to be missing the 25% that Silicon Valley is missing. But here's your days of unsold inventory, the supply-demand ratio. You can see the area that's the slowest is the Central Coast. Central Valley and North Bay are very close together at 80 days. And then the cities at 60 days. And the fastest one is Silicon Valley at about 48 days to sell all your existing inventory. So Silicon Valley is still a hot spot locally. And here's marketing time. Again, Silicon Valley is the hottest, where 3/4 of your sellers are selling out in about 35 days, basically 7 weeks. The other 4 regions are very close together, and they're just around 2 months. So that's, something approaching 7 weeks. So clearly a much slower marketplace than what Silicon Valley is experiencing. Here's the sellers' price reductions. You can see they're all going down, which is an increase in the decrease. 0% is up here at 100. The typical is the gray line here at about a 0.5% reduction. Silicon Valley has the least amount of price reductions going on at about 1.75% roughly. Then you've got 3 real close together. You've got Central Valley. Orange is the cities. Gray is North Bay. And they're coming in right around 1.5% reduction. And the area with right around 2.5% reduction. And the area with the most reduction is the Central Coast at almost just over 3% reduction off their ask price. And that's until they get the offer accepted. Frequency, Silicon Valley has the least. So again, I sound like a broken record, but Silicon Valley is clearly the hottest region, followed by the cities. Then you have Santa Cruz and Monterey, the Central Coast, and then North Bay and Central Valley very close together with almost just at 40% of the sellers doing price reduction. And that's 2 out of every 5 sellers are doing a price reduction. Here's the overbid. The area that's got the most overbidding, believe it or not, is the cities. It's outperforming the Silicon Valley by quite a bit. Silicon Valley's down here at about 3% overbid. Cities is up at 6.5%, more than double the amount of overbidding. Then everybody else is below. North Bay is taking about a 0.5% off. The Central Valley is taking about a full % off, and the Central Coast is taking about 2% off when they go in with the offer. So if the seller's asking $1 million, you're taking off $20,000 or 2% of that $1 million. Here's the frequency. Cities and Silicon Valley are very close together at 51 and 53%. Then you have North Bay at 34%. The Central Valley at about 29% of the sellers getting more than their overbid. And finally, in last place is the Central Coast at about 23.5% of the sellers getting more than their asking price. Here's the long-term appreciation. The big takeaway here is the cities. I'm going to have to expand the scale here to see what's going on with the Central Coast. It looks like it's right at my peak of 110% appreciation. This in the Central Coast, you have areas inland, but you have Soledad, Salinas, and then you have the expensive areas like Monterey Bay, Pacific Grove. So you have areas like King City that's very affordable. And if they're selling a lot of properties, that pulls down the median. So that would be happening down here. And then if you have a lot of properties selling along the coast, that pulls up the median and shows greater appreciation. I think that's why you're having that big changes here, the steepness of the slope. We saw that with Silicon Valley a few weeks ago. I did a breakdown and I showed, for Santa Clara County, I guess I did it was greater than each one of the micro market areas. Right now, that's true and more true in San Mateo County. And that's why you want to look at micro market areas instead of just globally. But anyway, you get the area that's clearly doing the least well is the cities. Down here, it's something like only 25% appreciation, and that's for 10 years. You come up here to the North Bay, and they're at least up around 65%, 64% appreciation. Silicon Valley is at 80%. Central Valley is at 90%. And as I said, the Central Coast is at 110% appreciation since the last 9 months of 2015. So now here's the pricing. You can see how quickly the price has gone up in the Central, giving you the high appreciation rate. It's way above its previous record. So Central Coast right now is having record high numbers. That's the only region that's there. Every other region is way down. So that's another strong indication that it's market mix, selling more expensive homes, fewer homes in King City area, Soledad area. Anyway, Silicon Valley is the most expensive out of the 5 regions, followed by the cities. That's a reversal, and you can see before the pandemic, the cities in Marin, San Francisco and Marin, were always more expensive than Silicon Valley. Once we got past the pandemic, we started having crossovers in 2023, and we've had several crossovers, and we have another crossover now where Silicon Valley is more expensive than the cities. Central Coast, as I already mentioned, is at the record high numbers. North Bay is doing just standing alone by itself. And then you have Central Valley, the most affordable region, at about $550,000 for the median priced home. And here's the monthly payments using the same formula, which is using the national average for the high balance conforming loan limits. Jumbo Money would give you lower rates. If you had relationship pricing with your bank, you'd have lower pricing. Here are the raw numbers. The now column is the current week. 1 week ago is 1 week is the percent change from last week. So inventory is up 3% in Santa Clara County, down 0.4% in San Mateo County, and on. And then also for 5 weeks ago. So you can see that trend between what's happened 1 and 5 weeks ago, as well as the raw numbers now. The yellow tend to be lagging indicators, and appreciation, price, 10 percentile and 90 percentile are just on there for information. They're useful. They sandwich the median price, which is a lagging indicator. These are the different chapters. I did change around the order. Any feedback on whether you like this order better or worse, or if you have any suggestions, I'm very receptive. All the timestamps are in the YouTube description below, so you can go to the graphic most meet your needs. Thanks for joining. Have a great week. See everybody next week. Take care. Bye for now.